You can ignore predictions but not patterns. Each century, wealth piles up, signals distort, and economies overheat. Then, reset. 1929, 2008, and now 2025's data looks eerily familiar. Rising profits, shrinking savings, broken trust in money. If Aya was right, distortion always ends in correction. The only question is, who gets crushed first? When inequality peaks, history presses reset. Every time wealth piles too high at the top, history quietly loads the reset button. It happened in the roaring 1920s, when the top 1% owned nearly 40% of America's wealth. Luxury cars rolled out of Detroit, champagne flowed, and the stock market climbed 250% in 8 years. Newspapers called it a new era of prosperity. But behind the headlines, the cracks were widening. Wages stopped rising. Farmers went bankrupt. By 1929, that prosperity vanished overnight. Stocks crashed 89%, banks collapsed, and unemployment hit 25%. Now, fast forward 80 years. Before the 2008 crisis, history was whispering the same warnings: record profits, massive speculation, stagnant wages. CEOs made hundreds of times more than their workers. By 2007, US households were spending more than they earned for the first time since World War II. Everyone thought housing would never fall, but when it did, $19 trillion in household wealth evaporated. And here we are again. The top 10% today control about 70% of all US wealth, the highest share in modern history. Tech billionaires multiply faster than small businesses can survive. Meanwhile, the median American has less than $5,000 in savings, and credit card debt has crossed $1.3 trillion. It's the same pattern. Confidence at the top, quiet struggle at the bottom, and an economy balancing on a needle. Inequality doesn't just make life unfair, it makes the system unstable. Because when the majority stop participating in growth, demand dries up. History doesn't reset out of revenge, it resets out of necessity. And what triggers that correction? Sometimes it's not greed, it's policy. Which brings us to the next twist. What happens when governments try to fix inequality by taxing prosperity itself? The tax curve that turns prosperity into pressure. Every time a government starts running out of easy answers, it reaches for the same old lever: raise taxes. It sounds fair. Make the rich pay more, redistribute, balance the books. But history shows something strange always follows. Instead of stability, the system tightens, innovation slows, and debt somehow still grows. Take the United States in the 1930s. After the Great Depression, Franklin D. Roosevelt raised the top tax rate to 94%. 94. On paper, that should have crushed inequality. But what really happened? Businesses stopped expanding. Wealth hid behind corporate shells and foreign accounts. And by 1937, the economy fell into a second mini-depression. Unemployment spiked again to 19%. The system wasn't producing, it was punishing. Europe learned the same lesson decades later. France taxed the wealthy so aggressively that between 2000 and 2016, more than 42,000 millionaires fled the country, many moving just across the border to Switzerland or Belgium. The wealth didn't vanish, it just relocated. And while the French state lost tax revenue, unemployment stayed high, stuck above 9% for years. Even the modern giants can't escape the math. The US government collected $4.9 trillion in taxes in 2023, the most in history. Yet the national debt soared past $34 trillion, the biggest ever. That means for every $1 collected, the system spends $1.30. It's a treadmill running faster than growth. Manuel Ayo warned about this decades ago. When the state taxes too heavily, it distorts prices and incentives. Instead of creating new value, people focus on hiding or defending what they already have. Productivity, the real driver of wealth, stalls. And when productivity slows, governments reach for a different trick: manipulating money itself. They print, they stimulate, they lower rates. That's when things start to look healthy on the surface but rot underneath, because money stops telling the truth. Let's dig into that next. When money stops signaling reality. Here's where things start getting weird. In every major financial bubble, money stops behaving like a signal. It starts acting like an illusion. Prices go up, everyone cheers, but nobody asks why. During the 2000s housing boom, central banks kept interest rates near 1%, hoping to stimulate growth after the dot-com crash. It worked, too well. Cheap credit flooded into real estate. By 2006, the average U.S. home had jumped 124% in price compared to 1996. Wages? Barely moved. Yet everyone felt rich on paper. This isn't new. In the 1970s, after the U.S. ditched the gold standard, inflation hit 14%. Gas prices quadrupled, bread doubled, and money lost half its value in under a decade. Manuel Ayau warned about this exact problem. When governments manipulate money, it stops measuring value and starts distorting it. Look around today, the same pattern. Central banks printed over $25 trillion globally after COVID. Stocks, crypto, and housing soared. But productivity, the thing that creates real wealth, didn't keep pace. That's why eggs went from $1.40 to $4.50 in just 2 years, and groceries still feel expensive even when inflation slows. Money is supposed to tell us the truth about scarcity. What's rare? What's valuable? What's efficient? When that signal gets corrupted, we build castles on quicksand. It feels solid until it suddenly isn't, and when the illusion finally breaks, we call it a crash. But in reality, it's just prices trying to tell the truth again. That's the cycle. The boom, the euphoria, the silence before the correction. And, as history keeps proving, it always comes full circle. The cycle that always comes full circle. History doesn't repeat perfectly, but it rhymes loud enough for anyone paying attention. Every financial boom carries the seeds of its own crash. And every crash lays the groundwork for the next boom. The rhythm is ancient. Take 1929. Stocks had soared 250% in 8 years. Radio, automobiles, and electricity were changing everything, and investors thought risk had disappeared forever. Then came Black Tuesday, a single day when $14 billion in market value vanished. Within weeks, it was $30 billion. That's like wiping out Apple overnight. Jump to the 1970s. Oil shocks, runaway inflation, and collapsing currencies after the US left the gold standard. Inflation peaked at 14%, mortgage rates hit 18%, and families lined up for gas. It was chaos, but the reset cleared debts and forced innovation. The 1980s tech and finance boom was born right after that mess. Then there's 2008. Banks, swimming in easy money and bad loans, thought housing prices could never fall. When they did, the global financial system almost stopped breathing. But from that rubble came Amazon's dominance, Tesla's rise, and the modern AI economy. Here's the strange truth. Every crash looks like an ending, but it's really a transfer. Wealth moves from the reckless to the patient, from hype to value. Ayau explained this as economic gravity. When prices detach from real productivity, correction is inevitable. Now, in 2025, we're watching another familiar pattern. Record stock valuations, trillion-dollar companies, cheap credit, and ordinary people taking on record debt. History isn't subtle. It's clearing its throat again. And when the warning lights start blinking, data always notices before people do. The next chapter is about those quiet signals, the numbers that whisper trouble before anyone screams. The data whisper before they scream. Before every economic reset, the data starts whispering. It's quiet, barely noticeable at first, but once you know what to look for, it's almost eerie. Numbers reveal the cracks long before the headlines do. Right now, global household savings rates are sinking fast. In the US, the personal savings rate dropped below 3.6% in 2024, one of the lowest levels since 2005. For context, during the post-war boom of the 1950s, Americans saved over 10% of their income. That gap isn't just a statistic. It's the difference between a system with a cushion and one running on fumes. Corporate debt tells another part of the story. Global non-financial corporate debt hit a record $94 trillion in 2023, up from $69 trillion a decade ago. In the US alone, corporate debt sits near $13 trillion, more than double what it was before the 2008 crash. And much of that debt isn't going into new factories or research. It's funding stock buybacks and executive bonuses. In other words, productivity flatlines while prices soar. The markets look euphoric on the surface. The S&P 500's profits are near historic highs, and yet real worker productivity has barely grown. up only 1.4% per year on average since 2010. Compare that to the 3% plus growth rates of the 1960s and 70s. Something's off balance. Aya would say the signals are distorted again. When easy credit and political stimulus mask inefficiency, you get fake prosperity, until the math catches up. The data, as always, starts whispering warnings before anyone's ready to listen. And when those whispers turn to screams, something bigger always follows. A reckoning that wipes away the noise and forces reality to take the wheel again. That's the moment when the reset begins. And no amount of denial can stop it. Reality always collects its debt. Every system built on distortion eventually meets its collector, reality. It doesn't send warnings or mercy letters. It just shows up and settles the bill. That's what Ayao meant when he said, "You can't cheat economic laws, only delay their consequences." Look at the Great Depression. The 1920s were fueled by margin debt, people borrowing to buy stocks. By 1929, nearly 90% of stock purchases were made with borrowed money. When the market turned, margin calls wiped out fortunes overnight. Within a year, industrial production fell 47% and unemployment hit 25%. The reset wasn't punishment. It was the system purging fake prosperity. Fast forward to 2008, the same story in a new outfit. Housing prices had soared 124% since 1996, and banks were giving mortgages to anyone with a pulse. When reality caught up, $19 trillion in U.S. household wealth evaporated in 18 months. The crash didn't destroy value. It revealed which value was never real. Now, in the 2020s, we see echoes of both. Trillions printed during COVID flooded into assets, stocks, crypto, housing. Yet productivity hasn't kept up. Global debt now exceeds $315 trillion, over 3.3 times the world's GDP. That's like owing $3 for every one you earn. When cheap money runs dry, inflated prices deflate. That's the reset. It's brutal, but it's balanced. It shifts wealth from speculation to production, from illusion to value. History doesn't call it fair, but it always calls it necessary. And the question isn't if the reset comes, it's who will be ready when it does. Because every collapse creates two kinds of people: those who lose everything, and those who rebuild from what's real. Thanks for watching, and for being part of the few who dig deeper. If you found this breakdown useful, subscribe for more stories that connect history, economics, and reality. The next video continues this trail because the data never lies, it only warns.